You know what nobody's talking about right now? The fact that silver just did something it hasn't done in over 40 years. And I'm not being dramatic here. The data is staring us right in the face, but most people are too busy watching the noise to see what's actually happening beneath the surface. Let me paint you a picture of what's unfolding. Silver just broke through a technical level that's held for decades. We're talking about resistance that's been tested, rejected, and reinforced more times than I can count. And it didn't just break through, it exploded through with the kind of momentum that makes institutional traders sit up and pay very close attention. But here's where it gets interesting. While silver was making this historic move, something else was happening in the background. The short positions on the COMEX, the exchange where silver futures are traded, reached levels that would make any risk manager nervous. We're talking about concentrated short positions that represent more silver than some countries produce in an entire year. Now, if you've been around markets long enough, you know what happens when you have a massive short position and the price starts moving against you. It's not pretty. It's actually one of the most violent moves you can witness in financial markets, because shorts don't have the luxury of waiting it out. They have margin calls. They have deadlines. They have bosses screaming at them to close positions before the losses get worse. And that's exactly the setup we're looking at right now. Let me take you back to a moment in history that most people have forgotten. January 1980. Silver was trading around $15 an ounce at the start of the year. By the end of January, it hit $50. That's a 233% move in 30 days. Not 30 months, 30 days. What caused that? A short squeeze. The Hunt brothers had been accumulating physical silver, and when the shorts realized they couldn't deliver the metal, panic set in. Traders who had sold silver they didn't own suddenly needed to buy it back at any price. And when everyone's trying to exit through the same door at the same time, prices go parabolic. Now, I'm not saying we're going to see a 233% move in 30 days, but I am saying the conditions are eerily similar. Actually, they might be worse. Because back in 1980, the short positions were concentrated in a few hands. Today, they're spread across banks, hedge funds, and institutional players who all think they're hedged, until they're not. Here's what most people don't understand about silver. It's not just a precious metal, it's an industrial metal. Every solar panel needs silver. Every electric vehicle needs silver. Every smartphone, every computer, every 5G tower, they all need silver. And unlike gold, which mostly sits in vaults, silver gets consumed. It gets used up in manufacturing processes where it can't be economically recovered. So while demand is exploding, and I mean truly exploding with the green energy transition, supply is barely keeping up. Mine production has been essentially flat for years. The easy deposits have been found. The high-grade ore is gone. What's left requires more energy, more capital, and more time to extract. And here's the kicker. The above-ground stockpiles that everyone assumed would buffer any supply shortage, they're disappearing. The COMEX vaults have been draining at a rate that should be making headlines. We're talking about millions of ounces leaving the vaults every single week. Physical silver is moving from west to east, from exchanges to private hands, from paper claims to actual metal. Let me give you some numbers that should make this crystal clear. The COMEX has about 300 million ounces of silver in its vaults. Sounds like a lot, right? Until you realize that the open interest, the number of contracts that represent claims on that silver, is equivalent to over 900 million ounces. That's 3 times more paper claims than physical metal. Now, under normal circumstances, this isn't a problem. Most futures contracts get settled in cash. Traders don't actually want the physical metal. They're just speculating on price movements. But what happens when that changes? What happens when holders of those contracts start demanding delivery? That's when you get a squeeze. And we're seeing signs that this is exactly what's starting to happen. Delivery notices are spiking. The amount of silver standing for delivery, meaning people are actually taking the metal instead of rolling their contracts forward, is at levels we haven't seen in years. The market is shifting from paper speculation to physical demand. Think about what this means for the shorts. They've sold contracts promising to deliver silver at a certain price. They assumed they could buy it back cheaper or settle in cash. But now, buyers are saying, no, we want the actual metal, and the shorts have to scramble to find it. Where do they find it? They have to buy it on the open market. And when you have hundreds of millions of ounces worth of short positions trying to cover, and only a fraction of that available for sale. What happens to the price? It goes vertical. I want you to understand something about market structure. The silver market is tiny compared to other commodities. The entire annual mine production of silver is worth about $25 billion. That's less than the market cap of many individual tech stocks. It's a rounding error in the global financial system, but that small size is exactly what makes it so explosive. It doesn't take much capital to move the silver market. A few $1 billion of buying pressure can send prices soaring, and when you have short covering on top of genuine demand, you get moves that defy logic. Let me tell you about what happened just recently. Silver spiked nearly 10% in a single week, breaking through the $32 level that had been resistance for months. It touched levels we haven't seen since early in the decade. And this wasn't on some random news event. This was pure technical momentum combined with short covering. The COMEX tried to cool things down. They always do when volatility spikes. They raised margin requirements, making it more expensive to hold positions. But here's the thing, that move backfired. Instead of calming the market, it forced more shorts to cover because they couldn't meet the higher margin requirements. It added fuel to the fire. And now we're in this fascinating moment where the shorts are trapped. If they cover, they push prices higher, which triggers more covering. If they hold on, they're betting that prices will come back down before their losses become unbearable. It's a game of chicken, and the clock is ticking. Now, let me shift gears for just a moment because this is important. If you're sitting on retirement accounts, maybe you've got $100,000 or more in a 401k or IRA, you need to understand how precious metals can fit into that picture. I put together a free guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. Worth checking out if you're thinking about diversifying beyond traditional stocks and bonds. All right, back to what's happening with silver. Here's another angle most people miss. Central banks have been buying gold at record levels. We're talking about hundreds of tons per quarter. China, Russia, India, Turkey, they're all accumulating. And while they're focused on gold, that's creating a spillover effect into silver. Why? Because silver is gold's little brother. When gold moves, silver follows. But it doesn't just follow, it amplifies. Silver is more volatile. It has a higher beta. When gold goes up 10%, silver might go up 15% or 20%. And when gold goes down 10%, silver can drop 15% or 20%. It's a leverage play on precious metals. But right now, we're in an environment where gold is making new all-time highs. It's broken out of a multi-year consolidation, and silver is starting to catch up. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically high. It's been sitting above 80, sometimes above 90. Historically, that ratio averages around 60, and there have been periods where it's dropped to 30 or even lower. If we're heading back toward historical norms, and gold stays elevated, silver has massive catch-up potential. We're talking about a scenario where silver could double while gold only goes up 20% or 30%. That's the kind of move that changes portfolios. That's the kind of move that creates generational wealth for people who position themselves correctly. Now let me address the elephant in the room. Why should you believe this is different from all the other times people have called for a silver squeeze? Fair question. Because there have been false alarms before. There have been rallies that fizzled out. There have been predictions that didn't pan out. Here's what's different this time. The fundamentals have never been this strong. The supply-demand deficit is real and growing. Industrial demand is not going away. It's accelerating with the energy transition. And the financial system is more fragile than it's been in decades. We're living in a world where governments are running trillion-dollar deficits as far as the eye can see, where central banks have printed more money in the last few years than in the previous century, where debt levels are at all-time highs, and there's no realistic path to paying it down. In that environment, hard assets matter. Things you can hold, things that can't be printed, things that have intrinsic value, they become increasingly important. And silver checks all those boxes. But there's another layer to this. The geopolitical situation is shifting in ways that favor precious metals. We're seeing de-dollarization accelerate. Countries are settling trade in their own currencies. The BRICS nations are talking about a gold-backed currency. The dollar's role as the global reserve currency is being questioned, in ways it hasn't been since Bretton Woods. What does that mean for silver? It means that as confidence in fiat currencies erodes, people look for alternatives, and silver, with its dual role as both money and industrial metal, becomes incredibly attractive. Let me give you a specific example of how this plays out. India has been one of the largest importers of silver for decades. It's deeply embedded in their culture: silver jewelry, silver coins, silver utensils. But in recent years, India's imports have surged beyond cultural demand. They're importing silver for industrial use, for solar panels, for electronics manufacturing. And India isn't alone. China is doing the same thing. They're building out massive solar capacity. They're electrifying their vehicle fleet. They're upgrading their infrastructure. All of that requires silver. And they're not just buying it on the spot market. They're securing long-term supply agreements. They're investing in mines. They're stockpiling. When you have the two most populous countries in the world competing for a finite resource, what happens to the price? It goes up. It has to. There's no other outcome. Now let's talk about the technical picture, because this is where things get really interesting. Silver has been in a consolidation pattern for over a decade. After the 2011 peak near $50, it crashed and spent years building a base. It tested the $15 level multiple times. It formed what technicians call a cup and handle pattern, a long rounded bottom, followed by a consolidation. That pattern is one of the most reliable bullish formations in technical analysis. And when it breaks out, the measured move, the expected price target based on the depth of the pattern, is substantial. We're talking about potential moves to $50, $60, even $70 or higher. But here's what makes this setup so powerful. It's not just the technical pattern. It's the fact that the pattern is forming at the same time as all these fundamental drivers are aligning. Technical analysis works best when it confirms what the fundamentals are already telling you. And right now, everything is pointing in the same direction. The moving averages are aligning. The 50-day is crossing above the 200-day, what traders call a golden cross. Momentum indicators are turning positive. Volume is increasing on up days and decreasing on down days, which shows accumulation. Every technical signal you'd want to see before a major move is flashing green. And then there's the sentiment picture. This is crucial. For a market to have room to run, you need skepticism. You need people who don't believe. You need shorts who think they're smart. Because those are the people who provide the fuel for the next leg up when they're forced to cover. And we have that in spades right now. Despite silver's recent strength, sentiment is nowhere near euphoric. Retail investors aren't piling in. There's no mania. There's no front-page news coverage. Most people still think of silver as that thing their grandparents collected. That's perfect, because it means we're still early. It means the real move, the move that gets everyone's attention, is still ahead of us. Let me paint you a scenario of how this could unfold. Silver continues grinding higher, testing resistance levels. The shorts keep adding to their positions, convinced that it's going to roll over. But it doesn't. It consolidates, builds energy, and then breaks out to new highs. That breakout triggers stop losses and forces some shorts to cover. The covering pushes prices higher, which triggers more stops and more covering. Momentum traders see the move and jump in. Retail investors start paying attention. Media coverage increases. And suddenly, you have a self-reinforcing cycle. At some point, the move becomes parabolic. Prices start gapping up on the open. Trading gets halted multiple times due to volatility. The COMEX raises margins again, but it doesn't matter. The shorts are in full panic mode, buying at any price to close their positions. That's when silver goes from 35 to 50, then from 50 to 70. And if the squeeze is severe enough, if the physical shortage becomes acute enough, there's no telling how high it could go. Because at that point, it's not about fundamentals or technicals. It's about survival. It's about closing positions before you get wiped out. Now, I want to be clear about something. I'm not saying this happens overnight. Markets don't move in straight lines. There will be pullbacks. There will be days where it feels like the move is over. There will be moments of doubt. But the underlying dynamics, the supply deficit, the industrial demand, the short positions, the monetary instability, those don't change. Those are the forces that will drive this market higher over time. And here's what you need to understand about timing. Nobody can predict exactly when a squeeze will happen. But what we can do is identify when the conditions are ripe. And right now, the conditions are as ripe as I've ever seen them. The shorts are more exposed than they've been in years. Physical demand is stronger than it's been in decades. The technical setup is textbook. The fundamental backdrop is supportive. And the catalyst, whether it's a geopolitical event, a currency crisis, or simply continued industrial demand, could come at any moment. Think about what happened in 2020. Silver was trading around $12 in March. By August, it was over $29. That's a 140% move in 5 months. And that was without a true short squeeze. That was just a combination of monetary stimulus, industrial demand recovery, and some speculative interest. Imagine what happens when you add a genuine short squeeze on top of those dynamics, when you have forced buying from shorts who have no choice but to cover, when you have physical shortages that make delivery impossible, when you have a market structure that's fundamentally broken and needs to reset. That's when you get moves that make history. That's when you get the kind of returns that people talk about for decades. And here's the thing about squeezes. They're binary. Either they happen or they don't. There's no middle ground. The shorts either get squeezed out or they manage to hold on and the market rolls over. But given the current setup, given the fundamentals, given the technical picture, the odds are heavily skewed toward the squeeze. Let me give you one more piece of the puzzle: the options market. When you look at the open interest in silver call options, contracts that give the right to buy silver at a specific price, it's heavily skewed toward higher strikes. There are massive positions at $35, $40, $45, and $50. What does that tell you? It tells you that sophisticated traders are positioning for a big move higher. They're not just hoping for it, they're betting real money on it. And these aren't retail traders buying lottery tickets. These are institutions, hedge funds, and professional traders who've done their homework. When the price starts approaching those strike prices, something interesting happens. The dealers who sold those options have to hedge their exposure by buying the underlying metal. It's called delta hedging, and it creates additional buying pressure. So as silver moves higher, the options market creates a feedback loop that accelerates the move. This is the same dynamic that caused the GameStop squeeze, the Volkswagen squeeze, and every other major short squeeze in history. It's not just the shorts covering, it's the entire market structure amplifying the move. Now, I want to address something important. This isn't financial advice. I'm not telling you to go out and bet the farm on silver. What I'm doing is laying out the facts, the data, the setup. What you do with that information is entirely up to you. But I will say this. If you're not paying attention to what's happening in the silver market right now, you're missing one of the most compelling setups in decades. This is the kind of opportunity that doesn't come around often, the kind where all the pieces are in place, where the risk-reward is heavily skewed in one direction, where the potential upside is massive compared to the downside. And the beautiful thing about silver is that it's accessible. You don't need to be an accredited investor. You don't need $1 million account. You can buy physical silver coins or bars. You can buy silver ETFs. You can trade silver futures or options if you're more sophisticated. The barriers to entry are low. But here's what you can't do. You can't wait until everyone else figures it out. You can't wait until silver is on the front page of every financial publication. You can't wait until your neighbor is talking about it at the barbecue. Because by then, the easy money has been made. By then, you're buying at the top, not the bottom. The time to position yourself is when nobody's paying attention, when the setup is there but the crowd hasn't noticed yet, when the smart money is accumulating quietly while everyone else is distracted. And that time is right now. The shorts are trapped. The fundamentals are strong. The technicals are aligned. The catalysts are in place. All we're waiting for is the spark that sets this thing off. And when it happens, when the squeeze really gets going, it's going to be spectacular. So pay attention. Watch the COMEX inventory levels. Watch the delivery notices. Watch the price action. Because what's about to unfold in the silver market is going to be one for the history books. And you'll want to say you saw it coming.